Welcome, everyone, to today's special episode of Receivables Info webinar, specifically talking about the economic effect of student loans in 2024 and beyond. For those that are just joining, we're going to give it just a minute as a few more people join. But in the meantime, I want to very quickly introduce our panelists. Who we're lucky enough to have join us here. First and foremost, Dan Simmons, Senior Director over at TransUnion. Dan, welcome to the webinar. Quick bio, if you don't mind.
Sure thing, Mark. Thanks, Mark, and thanks everyone for joining today. My name is Dan Simmons, and I lead the consulting team within financial services at TransUnion, and my team is responsible for reporting on monthly and quarterly trends within the consumer credit market.
Thanks, Dan. And second with us today, a true honor, someone I've known for most of my professional life, but someone who probably knows more about student loans, has forgotten more about student loans than I've ever known in my life. Lucky to be joined by Miss Mary Jo Terry. Mary Jo, take it away. Quick bio to those that don't know you in the space.
Thanks for having me. I'm a managing partner at a company called Alt Lending. We're a private education loan refinance company that assists people in good status and bad status. Been in the education industry for 20 plus years. Yes, I'm dating myself, as well as working with consumer lending finance. So very much aware of what's going on in this market and look forward to this webinar.
Thanks for joining us, Mary Jo. Having your candor and professionalism and expertise on this call really is going to make this something special. And again, why are we doing this? Well, I as a business owner of 20 plus years, think back on these events within the space. And I think that we're on the verge of something that's fascinating. And we're lucky enough to have access to a report that was created by TransUnion. Dan, I know, can tell us a little bit about what that looks like. Why is this report created, and furthermore, what are the kind of things that we're going to be talking about and on the phone today?
Sure. So as we all know, the federal government had a payment pause on student loans back in March of 2020. And they've recently resumed the fact that consumers had to start making payments here. I think it was in October. So there's been that long period where these consumers have not had to make any student loan payments. And so we've completed a couple studies. One was over the summer. It was kind of called a payment shock analysis that TransUnion, along with Boston Consulting Group, put together to look at what would be the impact of those payments on consumers. What percentage of them, for example, would have a $0 AEP, et cetera. And then this most recent white paper reflects what percentage of consumers are likely to go seriously delinquent over the next 12 months once these payment requirements are put back into place. So it's interesting information for lenders as well as agencies, et cetera, to know who these consumers are within your portfolio, identify them, because there's a high likelihood that they're going to struggle being able to either remain current or just to continue making payments to your companies.
I want to pause because you mentioned something, and I think that it's interesting because I think that's part of the discussion. Is as a private business owner for a very long time, we had very little experience with Pell loans or federal loans. We did, however, deal a lot with privatized loans. But before we go into the kind of some of those small differences, large differences, Mary Jo, talk to me a little bit about, I know student loans have restarted payment in October, but can we talk a little bit about, before we really dive into the data here, can we talk about some of the interesting observations about maybe some of the differences? Because as far as I know, we have a bipartisan agreement, yet interest rates haven't started. And there's some very interesting, I think, commentary that's taking place that private business doesn't have the ability to manifest so easily. Would that be a fair statement?
Absolutely. It's really quite interesting, the federal program. Even though loans have gone into repayment into October, there's been a lot of confusion on, do I need to repay my loan? Do I not to repay my loan? Do the loan forgiveness discussions. There's also the other interesting piece of this, which is no one's reporting on federal loans to any of the credit bureaus until October of 2024. So you're also sitting out there with consumers that, one, are refusing to pay just simply because they think their loans are going to be forgiven, and we don't know what's going to happen legislatively. Then you have the other situation where the consumer is a little confused with their loan servicers due to the changes during the COVID repayment reprieve. And then you have the individuals that really are sitting in a situation where they can't afford to make the payments due to the current economic situation. So a lot of people are either jumping in and saying, yeah, let's try to make these payments, but the mass majority are trying to figure out how to make the payments and what programs are available to them.
Is the deck stacked a little bit, guys, from a private versus federally funded type loan perspective? I mean, I feel at times that it's easier for some of the big guys to play fast and loose, where some of the smaller lenders are suffering as a result of that.
Absolutely. Being able to have the flexibility within the programs, especially when you're looking at, you've got your federal education programs that have all of these benefit programs available to them, repayments, non-payments, deferments, forbearances. When you get into the private world, you're kind of stuck in a little box because you've got investors you have to repay regardless of what size entity it is. And they may have a little more flexibility and ability to manage these individual consumers at a level that the smaller credit unions and banks may not have that flexibility.
So I'm leading into the next slide with this kind of lob out question. These are the survey results themselves. And in our lead up to this webinar, we really talked a lot about, what information can we read from these graphs? They seem simple at first, but I think that there's some very interesting things to look at, especially when you maybe go one layer deeper on some of these repayment schedules and some of these forecasts. Dan, do you mind giving us a quick overview, giving the audience an overview of what we're looking at here and what we can learn?
Sure. So we'll start with the graph on the left-hand side. Consumers who made payments during the pause, or the kind of the status of it. And what jumped out to me, of course, was the percentage who did not make any payments during the payment pause. You see that 74% number. 74% of consumers didn't make any payments during the payment pause. Now, what's interesting, you mentioned going behind the numbers. Half of that, a little more than half of those 74% who responded that they made no payments did so because they said they didn't have the funds available. So they were struggling to be able to make those payments, and that's part of the reason we had such a high number there. If we take to where we are today, we recently learned that 40% of consumers actually missed their first student loan payment. So we still have a high percentage of consumers who are not making payments. Now that I think it was October 2023 was the first payment that was supposed to be made, and we saw nearly 40% of them did not make a payment. One other item I want to cover, and this relates to kind of what we see on the right-hand side, the consumer ability to resume payments. Now, last summer I mentioned that TransUnion and Boston Consulting Group, our first study was related to the payment shock. And we discussed that a payment shock of on average $300 per month was going to be required for these student loan consumers to start making these payments again, on average another $300 a month payment. What we looked at was what the impact of that would be to AEP, which is aggregate excess payment. This is a metric that measures what the payment amount beyond the minimum payment due consumers are making. So for example, if as a consumer, if my minimum payment due across products is $500 and I'm paying $700, that means I have a positive AEP of $200, the difference between the $700 and the $500. So at TransUnion, we believe this is a great measure of consumer health. We've done a number of studies on it, and we've seen that as that number starts to come down, it's really a measure of, or can be an indicator of somebody who's really in trouble, even if they are a super prime consumer. As you start to see that AEP go towards zero, it's somebody who's going to really be struggling paying their bills. Now, within the study that was performed, what we found, of course, when we added in that payment shock, that extra $300 a month, of course, it negatively impacted those subprime consumers. Naturally, they're having trouble paying their bills as is, but adding an extra amount to them is going to be doubly difficult. I think we were somewhere around 85 to 90% of those consumers would have a zero AEP, meaning they were really in trouble, having a very hard time paying their bills. But the most interesting part of the study was that we found that there was a significant impact to the prime and above consumer. So we found that 44% of prime consumers, 32% of prime plus consumers, and 21% of super prime consumers were going to have a $0 AEP once these student loan payments needed to be repaid. And I think that's borne out here in the graph we see on the right-hand side. We can see 23% responded said they can't make the payments. And then another 23% said the only way they can make these payments is to modify their lifestyle. So we're definitely seeing some pain points with consumers here. And certainly as a lender, you want to know who these consumers are within your portfolio. And there are some programs you can recommend to them, and we'll touch on those later as we get into the study.
I don't think anyone would disagree that the world has essentially changed, not just from an employment standpoint, but from an inflation standpoint. Mary Jo, I know in the lead up to this webinar, we talked a lot about AEP, maybe not specifically as aggregate excess payments, but certainly as to what are these key indicators, and more specifically, how does that specifically tie into these consumers' ability to repay? For example, I know that on the chart on the left, it very clearly identifies that we had 26%, 27% that had made payments or made some payments, but what happens when those banks were sending those payments back? I think that's an interesting commentary on what's happened and the lack of communication in some degree that continues to take place, dovetailing into what Dan said about 40% of consumers just simply miss their first payment. What types of things, A, from a communication standpoint, and B, from key indicators within consumers' lives, do you think are most impacting these numbers?
Well, it's quite interesting to listen to the 40% of people didn't make their initial payment. And what we've seen within the industry is because of the change of loan servicers from some of the large loan servicers for the federal loan program into others, we're seeing that borrowers actually received incorrect billing statements. They were not given income-driven repayment programs, did not receive correct information or any information at all. So it's kind of an interesting indicator that 40% didn't make payments, but then there's a percentage in there that really didn't know where to make payments or what to do with that particular payment, or was trying to revise that payment moving forward. If you look at the graph on the left, it's really interesting because there was a large percentage of people who made payments throughout the COVID stay on federal loans, but then had those payments returned in anticipation for the loan forgiveness program. As well as people who had severe delinquency that were in default with the Department of Education had those accounts brought forward. So that's going to dramatically impact what we're seeing with the consumer's ability to resume payments or to start to make payments again, because the percentage of people that went back into repayment was larger than when we started at the very beginning. Not simply students coming out of college and graduating and moving forward with life, but really bringing consumers back into those numbers that weren't there before. And the fact that we're not going to be reporting to the bureaus until October, it's really going to be interesting with the white papers and the surveys going forward to really make the determination of who's in that population and what's going on, because it's going to be difficult to trend. The last piece that I'm going to add very quickly is that with the private education loans, variable interest rates, and the interest rates going up significantly, you're seeing a lot of prime and super prime consumers that have never been in any inability to make payments are running into that. And then you add federal loan payments on top of that, regardless of what your age demographic is, whether you're in your 20s or you're in your 50s or 60s with supporting your children, it's affecting everyone across the board.
You mentioned affecting everyone across the board. And so let's talk about that just real quick, because I think that for the last several years, as I mentioned, the world's changed. All of these loans were recalled from agencies, from vendors, from all servicers. And that was 2020.
Yes, it was 2020 into 2021. Anybody that had a defaulted or charged off federal loan that was sitting with the collections or a law firm was actually called back. If the consumer had been making payments, those payments were refunded back to the consumer. So the pool of federal borrowers is now substantially larger within the bucket of repayment. So when we're talking about consumers' ability to new and continue with payments, you're going to run into this situation where the populace is going to be dramatically larger within that pool.
Right. And so going forward, where do you see that process landing over the next 2 or 3 years? All of these vendors, all of these servicers need to reapply, need to re-engage. Do you think it's kind of par for the course, or do you think this is a new era, kind of unforeseen based on inconsistent treatment across the board and unforeseen economic forecast? I know that's a bit of a crystal ball question.
I really believe we're going into an absolute new era.
Yeah.
Trying to determine what the Department of Education is going to do moving forward with a collection strategy. People in charge off legislation hasn't changed. The definition of when you go in default is the same number of days as it was 10 years previous. And so it's going to be very, very interesting to see what they're going to do. They're going to have to re-engage vendors. We have received confirmation that that's going to happen within the next 90 to 180 days, because a significant amount of this portfolio is just going to go what we call into immediate default, where these individuals have never even attempted to make payments and are waiting for these loans to be forgiven. So really, it's going to be an interesting era, and what they're going to allow us to do. Are they going to allow a true rehabilitation? Let's get these consumers back into repayment, or are we really going to go into a collections and loss strategy? It's going to be an interesting era moving forward.
Thanks, Mary Jo. Dan, I'm jumping into the next couple of slides here, and you've heard me say this before. For those that know, Dan and I are kind of super nerdy, as you can tell. Mary Jo is super nerdy too, just not as externally nerdy like Dan and I are. But let's talk about, where did this data come from? I think it's important to understand where the data comes from before we start picking apart the data to understand how it impacts the space. And so the next two slides really talk about that impact group and how did TransUnion come up with these impact groups, and what do these slides tell our audience about what we can learn from these things?
Sure. So, excuse me. First, the data came from the TransUnion Consumer Credit Database. So that's where we took the report. And as I talk through this slide, I'm going to focus everyone on we'll start on the right-hand side, that impact group. I think it might be easier to kind of explain what's in the impact group, and then we'll go back and talk about what we excluded. So first of all, the impact group includes two types of consumers. We see the total number of consumers in the impact group at 21.9 million, close to $1 trillion. And the first group are consumers who had their payments paused, but now they have to resume payments. So, for example, that would be somebody who is making student loan payments or required to do so back in March of 2020. Then they had the payment pause for about 3 years. Now they're expected to again start making payments. So that's 14.8 million consumers, about $565 billion. Next to that, we have those consumers who graduated from college, or their student loans came due between the time when that payment pause started back in 2020 and today. So we have 7.1 million consumers, $354 billion. So where we're at in total, again, 21.9 million consumers, $919 billion. That's the actual impact group. Now, what's been excluded along the way is there in the bottom section, the green. We've got three kind of segments of consumers that have been excluded. So first, we have those consumers who remain in deferral due to them being in school or still being under a grace period. So that's 8.7 million consumers, about $356 billion. Then in the middle, we have those consumers who have private student loans or some type of federal loan that wasn't eligible for the payment pause. So that's nearly 5 million consumers, $126 billion. And then finally, we have the consumers who are currently seriously delinquent on any product. So these consumers were removed as we figured they already are known to lenders as having higher risk, and that the resumption of the student loan repayments is not going to have as large of an incremental impact on this group. So those are the groups that were kind of removed from the study, and those that are included again are those who had their payment paused and are having to resume, and then people who are newly graduated making payments for the first time.
Fantastic, Dan. Talk to me a little bit about really diving back into some of the things that you had mentioned regarding AEP here. How can collection agencies, how can debt buyers, how can vendors in the space look at this impact group and say, hey, here is a group of consumers that we have to be able to model after and identify some subsets of portfolios that are being serviced as higher or lower risk? Anything from the numbers that you could say from a forecasting perspective that may be something different than what we've seen before in the past?
Well, I'd say one of the things that was surprising from that first study that we did over the summer was the high percentage of super prime consumers who were going to have $0 AEP, who are really going to be struggling. You would think it's really going to be the below prime consumers. You figure super prime consumers are able to handle this, extra payments, et cetera. But between the time where the payment pause happened and where we are, say, today, we saw a pretty significant increase in consumer spending. We saw credit card balances have increased. I think the average bank card balance is now $6,300. People went out and bought new houses. They got new auto loans. Of course, auto prices have been going up, housing, et cetera. So it wasn't just the below prime consumers that were struggling, or that were going to struggle. We saw pockets, certainly a significant number of them in the super prime that was also going to be negatively impacted. We also looked at it by generation as well. And it wasn't just the younger generations. There are some older generations who have a higher percentage of, or a higher, I should say, payment shock coming to them because either they've gone to graduate school or higher education, or perhaps they're helping out with their kids. And then they are also impacted by that payment shock as well.
And I know we're going to talk a little bit more about the delinquency by group in a couple more slides. But to we're still really on the same topic, same slides here when we start talking about these scenarios. But can we talk a little bit about, and Mary Jo, maybe I start this one with you. Do you see this an impact in save, or do you see further obfuscation, further confusion as we kind of head into this era where forgiveness has clearly impacted servicing? That's clear across the board. And, what do we have to learn from that? And what do you see as things that could more seriously impact this delinquency number?
Really, it's going to be a lot of the communication coming out of DC and what they decide with regulatory negotiating, and are we going to move forward with loan forgiveness? There's a huge percentage of population that are like, I'm not going to repay my loans. I want the money to sit there. I owe $20,000. $20,000 is going to be forgiven, or I owe $10,000 and $10,000 is going to be forgiven. The other thing is re-education all over about the ability to reduce your payments and go into an income-driven repayment program, or if you're still unfortunately unemployed, any of the deferments that are available in economic hardship, really educating all of these individuals that there are options, but also communicating the incredible impact by defaulting on federal loans, and realistically how that impacts your credit and how it really impacts your everything you do. Every single household expense is going to go up based on your credit, car insurance as an example, and really creating that education moment again, and really giving the consumer this is what's really going on. And is there going to be a $400 billion forgiveness program moving forward? and the confusion associated with the credit around this. Once again, I mentioned earlier, we've got a new group of individuals that are going to be in this bucket that we really need to address it. And 3 years later, 2.5 years later, do we really remember all of the things that are available? Probably not.
Dan, you want to touch on, for anyone that's actively live listening to the webinar, a copy of the TU study is actually in the group webinar chat. For anyone that's tuning in on a recorded version, those links will be in the description. But batting it back over to you, Dan. Dan, talking about our current slide here and the SAVE program and estimates on enrollment into SAVE, do you mind touching briefly on both what is SAVE for those that don't know, and forecasting what's to be learned from this?
Sure. Yeah, so it's definitely important to understand the SAVE program, whether you are a student loan, you're collecting on student loans, or you're a lender. You've got these consumers in your portfolio, so you want to know who they are. That's the first step. And then what the SAVE program does is it allows for an income-based repayment. So, for example, the SAVE program will they'll allow your payment based on your level of income as well as the size of your family. So from there, they can lower your monthly payment. There may even be some forgiveness for consumers with student loans. So certainly this is something for lenders who have student loan consumers in their portfolio. This should be part of the talk off. If they're having trouble making their payments, are they enrolled in this program, kind of helping them out. We talk about this in the white paper in terms of some of the recommendations that you should be making this known to those people in your portfolio. Now, in terms of the estimates for consumer serious delinquency by scenario in this slide, I'll kind of describe what we're looking at here. So on our last slide, I referenced the impact group was 21.9 million consumers. And now we start looking at the impact of the payment resumption on these consumers. So the first step in the first bar there on the left-hand side forecast the baseline scenario. This is the number of consumers who are going to become seriously delinquent in the next 12 months without experiencing any increase in their payments. So again, that's the baseline scenario. This number is 2 million consumers, and it represents 9.2% of that impact group I talked about earlier, that 21.9 million consumers. Now, next we take a look at the high and low enrollment scenarios within the SAVE program that I just talked about. These do assume payment increases for consumers across the impact group. So we start in the middle with the high coverage scenario. And what the high coverage scenario means in this case is that every single consumer who is eligible for the SAVE program will enroll in that program. So we see that estimate that under even the rosiest of scenarios where everybody enrolls in that program, that still an additional 500,000 consumers are going to become seriously delinquent. And that accounts for 11.2% of the impact group. And then finally, on the far right-hand side, we look at the scenario for the low enrollment in the SAVE program. And we took low enrollment and kind of put it even with the current enrollments today in the IDR programs. So now with fewer consumers enrolled in the SAVE program, that's going to lead to higher delinquency levels. So we see that number, the number of consumers going seriously delinquent up to 3.4 million, and that accounts for 15.5% of the impact group. So
Thanks,
that's
Dan.
the breakdown of the estimates there.
The next two slides we're going to look at are probability of repayment and that priority of payment. Again, I think historically, in my experience, there's been a pretty consistent application of consumer priority payment. House comes first, auto comes second, everything else kind of falls somewhere below that. The next couple of slides here, we're gonna dig into this, and we're gonna dig into I have a question to both of you, and I know this is it's a bit of a red herring in that we talked about this, but are these numbers right here that we're looking at accurate today versus 6 months ago from the report? What changes do you think might be seen here? I'll start with you, Mary Jo.
I think the changes that we're going to see here realistically goes back to the fact that we're dealing with, even though we're talking about student loans, we're talking substantially about federal student loans, but the inflation overall and the cost of everything going up, and the priority of student loans being at the bottom of the bucket, realistically, these numbers are going to continue to grow, and that is anticipated whether you're in the federal market or the private education consumer. And unfortunately, we've got a lot of student borrowers in the federal, but then we have a lot of parents and associate individuals in the private bucket. So we're going to start to see these numbers grow substantially just based on household income at this point.
Right. Dan, what do you see in the auto space?
Yeah, within the auto space, we've of course seen prices continue to climb. We've seen some delinquencies near term have increased as well, particularly for used vehicles. But as you mentioned, we do see that very high on the payment hierarchy, which we'll get to in a minute, because everyone has kind of a vested interest of keeping their car that they may still have some equity in, which is something we weren't used to in the past. I will say, to add on to what Mary Jo said, we have seen when she talked about inflation, we hear a lot about, well, inflation has been cooling, and that certainly is the case, and it's definitely a good thing. But as we look over what's happened over the last 2 years, yes, we had, I think, an inflation reading of 3.1% this last month. I think November is the last number we have. But prior to that, it was 7.5% the year before. So, over 2 years, we're over 10%. And yes, it's cooling, but we've seen a dramatic increase in balances, a significant increase in the amount of monthly payment obligations that consumers have. We've only recently started to see wages outpacing inflation. So certainly consumers are under some stress, and we do anticipate a bit of a slowdown in the economy this year, not necessarily a recession, but we won't see as robust of growth as we've seen in the last year. So that's going to lead to higher delinquency rates later in the year, likely across each product.
I know on our calls leading up to this, we had talked about some historical default rates, and we know that auto default specifically is kind of reaching default rates we haven't seen we're talking pre-recession, 20 years, 30 years. From a student loan perspective, and I appreciate, right? I think we've looked at so many different external factors that are beyond the control of the vast average consumer in the United States. The cost of gasoline here in California versus that in Florida or most other states is significant, as is the cost of things like groceries. Where do you see things going from a subprime market, Dan? And I know that we don't talk about that in great specificity in these slides, but I know leading up to this, we did really talk about how that subprime market has a good chance of really skyrocketing as a result of both, whether it's a lack of clarity or just simply an abundance of increase to that cost of living. Where do you see us in the following year in that market? And kind of whether it's a Dan or Mary Jo question, I'm interested from a forecast perspective, where you see those subprime markets lending, and does that have an additional impact that's not covered so much here? We know there's going to be a massive impact to the subprime market or to the prime market. What does that look like on the other end of that spectrum?
I think even with, if we think about subprime consumers, they're always in their own personal recession. So, the economy might be doing great, but they are struggling to pay their bills, make ends meet, et cetera. Certainly with inflation on top of that, it's really hurt the people with lower incomes. Obviously, it has a larger impact on them, as well as those in the below prime space, who are already struggling to make ends meet, and then you're adding higher prices on top of it, makes it that much more difficult for them. I think really what's been the saving grace really over the last couple of years, at least, as we've gone through this period of very high inflation and some economic uncertainty, has certainly been the job market. We've had very low unemployment. That's really helped to keep a lid. Yes, we are seeing increased delinquencies across products. But I think that the strength in the job market has helped to keep a lid on that growth, and particularly within the subprime and or below prime areas as well. Certainly, if we were experiencing, I think we're at now 3.7% unemployment. If we were north of 5%, we would see relative increases in delinquency across the board, given the size of the growth imbalances that we've seen and kind of the stress on the consumer I talked about. I'll turn it over to Mary Jo, see if you've got any insights on that as well.
I look at this a little bit different because what we're seeing is we're seeing record numbers of charge off with private education loans. And what we're seeing is more and more portfolios going to market due to the charge off rates at a level that we have not seen in the last decade. We now are seeing private education loan lenders looking for people to buy their debt versus the other scenario where everyone was soliciting them and they had the ability to pick and choose. That as a result to the consumer means increased prices, right? As more and more of these assets are having to be sold off, usually we'll see the lenders have some other way to try to make up the difference associated with their portfolio and the organization itself. So I look at it from not only a consumer standpoint, but from lenders themselves and how they're managing the private education market. And we're going to probably start to see some locking down of credit criteria, which then reduces the consumer's availability and associated costs to this asset class. So it should be very interesting going into 2024. A great opportunity for debt buyers out there, but it's going to end up ultimately costing the consumers a little bit more.
Fair. So the next slide is really talking about priority of payment. I've got these accounts, and this is the priority that most consumers are paying these loans in. Let's talk about some changes to this, because I think this was really an interesting discussion point in advance of this call, because I think it led us into really trying to determine, where is it? We're seeing increases to auto loans and auto loan defaults. Likewise, are we going to see increases across any of these other product type bands, silos? Dan, you want to start with that one?
Sure. I think in terms of auto and you touched on mortgage earlier, we get a lot of questions. Are we from our clients saying, "Oh, is this? Are we likely to see another problem with mortgage rates?" As we have seen mortgage rates coming up. Are we looking at something like 2007 as a precursor to what happened then? I'd say it's a totally different scenario at this point. Back in 2007, we had a very high number of consumers who didn't have very good credit compared to where we have now. I think it's something like 70% of all balances in the mortgage space are held by super prime or a 720 plus consumer. So it's less likely we would see people walking away from all that equity they have in their homes as well. In terms of auto loans, I think with, as you mentioned, we've seen the prices for autos increasing significantly. Yes, there's insurance is going up, gas, et cetera, but with the value of the autos having increased quite a bit over the past couple of years, I know it's been leveling a bit recently, but that's certainly another one that people are really prioritizing just due to the value that they've gleaned from that as well. I wasn't surprised to see the payday loan so low on the list in BNPL. Excuse me, but those typically the payday have higher delinquency rates anyway, and people are focusing on, again, the rent, mortgage, and auto as the primary bills that they want to pay first.
Mary Jo, what are your thoughts here? With private and federal student loans ranking so low on the priority chart, are there opportunities? Is this a different game than it was, let's say, 10 years ago?
Absolutely. Federal loans, we never thought would go into a hiatus of non-repayment for such a significant period of time, or that we were looking at possible loan forgiveness across the board on federal loans. So it's definitely going to change the market and the mindset as federal loans are going into repayment and people are attempting to pay those. The pressure on the private student loans, the delinquency and default rates are going to go increasingly up, as well as due to the variable rate interest rate market. So we're anticipating that defaults associated with private student loans is going to go up substantially. Federal loans, it's going to be really interesting to see what happens over the last year, because there's new groups that of students that are, I'm just not going to make a payment. It doesn't have anything to do with the specific asset itself, just I don't want to pay back my student loan. So that's going to impact federal loans as well, as we go forward. The big impact right now is the servicers not being able to communicate with the customers effectively and provide them the information that they need, which that's, probably a 90-day short-term scenario. But that particular market's going to get hit pretty significantly in the coming year.
So let's roll into the next slide, which really talks about the groups, which and we've touched on several of these aspects, and including the first one here, which is that non-prime and prime differences and who is more likely to have an increase. From this particular graph, and I'm sorry, I keep glancing over. I know we talked a lot about the generation, and we have a pretty smooth application of that. Do we see any changes to these silos as we head into 24 as a result of the things that we've talked about, especially from a credit quality perspective, seeing that historically that prime perspective has been, or segment has been very, very small? Dan, thoughts on that?
I don't think we'll see a major shift maybe with the generations, but perhaps the younger ones, if we have weakness in the job market, we may see maybe some numbers change here. But from the report that was put out, or the study that was put out over the summer, as well as this most recent white paper, we didn't see a big difference between trends within the generations. And that was kind of a surprise, something that came out of it. Certainly what we've talked about previously, the rates of delinquency among the different consumer groups, we're seeing a significant, or more of a significant impact to those lower income consumers, as well as the non-prime consumers, following up on some of the reasons we talked about earlier with inflation, some other economic challenges, and what it means to add that payment back into the mix, and how they're less able to adapt to that than some of the other groups are.
Mary Jo, I'm going to shift gears just a little tiny bit, because I know you mentioned it earlier. You had mentioned earlier this impact to credit scores as a result of, let's not call it forgiveness, but let's call it, for a lack of non-reporting. How does one appropriately apply, let's call it a $25,000 delta, to the expected repayments of consumers who are just unwilling to pay? Right. And I realize that's almost a circular question, but I feel like it's challenging for a business owner out there to try and identify which subset of these accounts are ones unwilling to pay student loans, while at the same time having an aggregate excess payment amount that would allow them to perhaps get ahead of some of these other obligations. Asking that within the context of, I think when you're looking at, as I said, this particular slide is low coverage estimates, so we're only looking at a kind of a subset of this impact group. But from a collection agency, from a debt buyer perspective, I have to think that has an overbearing impact on our ability to model our customers' propensity for payment.
Absolutely. Trying to determine which consumer is going to repay and which consumer is not going to repay, and the reasons why. It's very, very difficult. But I think some of what we're going to see is going to be based on generation and age, based on the fact that, promises were made and promises weren't kept moving forward. And that's going to be a huge impact. And one of the things that I've seen people, other organizations and other entities doing, is trying to educate on really the credit impact and the long-term impact of not repaying this debt versus filling out a piece of paper in order to pay $50 a month from now for the next 20 years, and really what that actually looks like and how that education is going to be given. And I think from a generational standpoint, we're going to see significant delinquency from the 20 to 30-year-old increase as we go through this particular process. The
Sure.
problem with that is that they don't have long-term credit histories. So as a result of that, you're looking at a significant period of time to try to bring yourself back out of that delinquency default scenario, just simply because they do not have some of the things that were listed on the previous slide, like a mortgage.
Right. And, in advance of this, we really talked about, Dan, is being able to leverage, and we didn't have time to really dive even deeper into the numbers with product by grouping, delinquency by grouping by credit card type or installment loan, and the likelihood of those individual product types and their delinquencies. But we can always save that for a later webinar. The last slide that we talked about, and this is the one that's, I always feel like the point we're trying to make. I think we summated it well in ending on this slide, because as you both mentioned, for the first time in a very long time, we have federal lenders that are looking to sell. Dan, do you want to give us a quick overview of this particular slide? And then Mary Jo, I know you've got some opinions regarding, where this leaves the industry, where this leaves those that leverage data sources like TransUnion, and more often, where does it leave the consumer?
Sure. Yeah. And so this slide looks at provides the delinquency calculations for all the products. So both in the high and low coverage scenarios. So if we start with the chart on the column on the far left-hand side, we start with the number of consumers who have this product and are not seriously delinquent on any product. And then we kind of go from there. So if we look at the first line for card, we've established a benchmark on the number of consumers who would become seriously delinquent on each product in that 12-month period. So that's the next column. Looking at card, in this case, we expect an additional 191,000 to 600,000 consumers who have a credit card to become seriously delinquent on at least one of their cards over the next 12 months. And then we show on the far right-hand side, we see relative to our benchmark, this would represent an increase of 3 to 10% in the number of consumers who will become delinquent. And then we have it broken down by the different product types throughout. Now, you did mention when we were talking on the last slide, I just want to get back to that real quick. The overall study didn't show a big difference between the number of consumers within different generations who will be going delinquent, but certainly there's certainly higher risk, and we've seen this across products with the younger generations having higher levels of delinquency rates, et cetera, relative to Gen X and baby boomers, et cetera.
As a Gen Xer, I took that personally.
Me too. I know, offensive.
Mary Jo, I mean, I'm hearing more increased opportunities, not just from agencies, debt buyers, that first and third party, but where does that leave the consumer, and what as businesses can we do to account for that, stay informed and stay educated about increasing servicing? I mean, I think we've learned the lesson of more communication is better, but it's the right communication at the same time. 10 more letters doesn't always do the trick, but in this particular instance, I think that the forecast that delinquencies are on the rise is an easy one to make. But more so, how does that impact, and what do you expect to see out of the student loan space?
Well, to Dan's point, I think communication has to be completely different moving forward with these individuals, and really trying to adapt from a collections delinquency communication standpoint to really taking a look at your consumer. Dan mentioned earlier, really talking to your consumer who you may be speaking to about a retail card, and then talking to them about, what are you doing about your other debt, your student loans, in order to receive a bigger receivable at your end, putting them into a different scenario. Also really thinking about how, whether it's a letter, whether it's a phone call, whether it's actual physical mail, and how we're communicating with these individuals and essentially becoming their advocates. It sounds crazy, but if you really want to get that receivable in, sometimes it's an extra 5 minutes on the phone and having a conversation to figure out where their debt is and how they can budget and flex through this process. And I think as a business owner or a lender or anybody who is attempting to collect on these or really try to put these people in a different place, I almost say it's not collections, it's really customer service and taking the extra 5 minutes and determining, hey, can we get you into an income-driven repayment program? Can we do this? And that extra $200 may end up with your company to really pay down that credit card or to really pay down additional debt that might be outstanding and put these people in a situation or these consumers in a situation where they feel like they're winning instead of constantly losing. And that's going to be really important going into 2024, because with the hiatus and with the non-communication that we did, communication is going to be key, as well as really customizing the way you're communicating with the consumer, with the generation, and taking that extra step if you really want to make this successful.
Fantastic. So Dan, I know we only have a few minutes left, so I'd like to kind of wrap everything up. The moral of the story for those that want to understand more information or get more information from you, Dan, I'm going to give you a 1-minute conclusion statement. And again, we wouldn't be able to do this without you being willing to share this information. So, I personally thank you. I love drilling into numbers and data and things like that. So, thank you. Thanks to TransUnion for allowing us to have this conversation. But for our audience, it's that one piece, the Dan Simmons final piece of knowledge regarding the ongoing effect of student loans, 2024 and beyond. Take it away.
Sure. So first, thanks for having us too. Really, it's been a pleasure working with you, Mark and Mary Jo, and attending this webinar, participating in it. But really, the bottom line within the study is that consumers who have student loans who are experiencing an increase in their payments really present a much higher risk of serious delinquency than those who do not. So it's something that if, as an agency, granted, they're in this case, they'd be less likely to pay you. If it's on first party side, they're more likely to charge off, et cetera. So really identifying these consumers, and we have methods that we have available to us at TransUnion can help you to identify them in your portfolio, segment them into the things that Mary Jo talked about before. Working with them, recommending that SAVE program would be one thing, trying to get them to prioritize paying your bill first. Certainly, if we talk from an agency perspective, you're not really worried about originations and account management, maybe as much as a lender does. But within the white paper, we do believe that lenders really need to review their credit loss forecasts, originations, and account management to account for the number of student loan consumers they have in their portfolio. And to a degree, that likely translates over to agencies as well. You need to know who these people are in your portfolio and work to help them out because they're going to struggle as they have to make these payments going forward.
Very
I don't know if
succinct.
that was
Yeah, thank you. No, that's absolutely. Mary Jo, I know it's a little tough to follow, but I think your perspective is uniquely different, and I know you're going to razzle dazzle everyone on this call. And again, thank you for sharing your unique perspective with us on this call. We wouldn't have been able to do it without you, and I thank you very much.
Well, Dan, you're a hard act to follow, but I 100% agree with everything that you said. You really have to identify the student loan borrowers that are sitting out there. I get to speak with them every single day and take a breath because I hear some of the saddest stories you can possibly imagine. And they are desperate to find a repayment solution. And that's going to be incredibly important regardless of what kind of credit or what kind of business you have in place. We're talking about 41 million plus people against every single age group that's possibly out there, from people in their 20s to people in their 70s. So it's incredibly important to identify this particular asset class, regardless of what kind of product you hold, and really try to be their advocate. I'm always stressing, be their advocate, show them a way out, because you will get the extra $200 that they have left over if you are. If you're not, they're going to give that money to someone else. And really just taking 5 minutes and figuring out what's sitting in your portfolio that you haven't had to look at in the past. That's going to be incredibly important.
Fantastic wisdom from two legends of the industry. Again, I thank you on behalf of Receivables Info. And with that being said, I do not see any audience questions. I will end the webinar. Thanks again, and tune in to next week's episode. Thank you so much.